What if everything you've been told about getting rich is unnecessarily complicated? Turn on the news, open YouTube, or scroll social media, and you'll hear the same message over and over. You need insider knowledge, complex strategies, hot stock picks, crypto trends, real estate hacks, and constant action. Investing sounds like a full-time job. One wrong move and your future is ruined. But The Simple Path to Wealth by J.L. Collins starts with a radical idea. Building wealth doesn't have to be hard, exciting, or complicated. In fact, the more boring it is, the better it works. This book wasn't written for Wall Street pros. It wasn't written for hedge fund managers or day traders. It was originally written as a series of letters from a father to his daughter, explaining, in plain English, how money actually works, why most people lose at investing, and how to avoid the traps designed to keep you broke, stressed, and dependent. And here's the uncomfortable truth Collins reveals early on. Most people aren't bad with money because they're lazy or irresponsible. They're bad with money because the system is confusing by design. Banks, financial advisors, and investment companies make more money when you don't understand what you're doing. So Collins does something rare. He strips everything down to first principles. No hype, no magic formulas, no get-rich-quick fantasies. Instead, he focuses on 3 simple questions that quietly determine your entire financial life. How much of your income do you actually keep? Where do you put your money once you've saved it? And how do you make sure that money works for you without needing constant attention? Along the way, The Simple Path to Wealth dismantles some of the most common financial myths. That you need a financial advisor to succeed. That timing the market is possible. That you need dozens of investments to be diversified. That retirement is an age instead of a financial condition. Collins argues that the real goal isn't retirement at 65. The goal is freedom, the freedom to walk away from a bad job, to say no to toxic environments, to make decisions based on values instead of paychecks. He calls this FU money, not as a joke, but as a mindset shift. Money isn't about stuff. It's about control over your time. What makes this book powerful isn't just the strategy. It's the clarity. By the end, you're not left wondering what to do next. You're given a simple, repeatable path that has worked for millions of ordinary people. No genius required. No constant monitoring. No stress. In this summary, we'll break down the simple path to wealth into its core ideas. How to save, where to invest, how to protect yourself from market crashes, and how to build a life where money fades into the background and freedom takes center stage. Because sometimes, the smartest path forward is the simplest one. Chapter 1 of The Simple Path to Wealth starts by challenging one of the biggest assumptions most people have about money, that the goal of saving and investing is retirement. J.L. Collins argues that retirement is the wrong target. It's vague, outdated, and often misleading. The real goal isn't to stop working at a certain age. The real goal is financial independence. Reaching a point where your investments can support your life, whether you choose to work or not. Collins explains that when people focus only on retirement, they often delay action. They tell themselves they have time. They stay in jobs they hate because quitting feels impossible. Money becomes something tied to age instead of freedom. Instead, Collins introduces the idea of FU money, money that gives you options. When you have enough saved and invested, you gain leverage. You can walk away from a bad boss, reduce your hours, change careers, or take time off without panic. This is not about luxury. It's about control over your time and decisions. The chapter also emphasizes that financial independence is not just for high earners. It's mostly about behavior. Saving a meaningful portion of your income and investing it consistently matters far more than trying to get rich fast or picking winning stocks. Collins makes it clear that money is a tool, not a scoreboard. Chasing status, stuff, or comparisons leads to stress and dissatisfaction. Using money to buy freedom leads to peace of mind. By the end of the chapter, the foundation is set. This book is not about retiring early, escaping work, or chasing extreme frugality. It's about building a simple, reliable system that gives you choices as early as possible. That mindset shift becomes the cornerstone for everything that follows. In Chapter 2, J.L. Collins addresses a topic that almost everyone relies on when planning their financial future. Projections, charts, calculators, and retirement models promise to tell you exactly how much money you'll have decades from now. Collins argues that while projections can be useful, they are also dangerous if taken too seriously. The core problem is simple. Projections assume the future will look like the past. They rely on average market returns, stable inflation, and predictable behavior. Real life doesn't work that way. Markets crash, inflation spikes, jobs change, personal priorities shift. When people treat projections as guarantees, they build false confidence or unnecessary fear. Collins explains that small changes in assumptions can lead to wildly different outcomes. A 1 or 2% difference in returns, savings rate, or spending can dramatically alter the final number. This makes long-term projections fragile, especially over 20 or 30 years. The chapter also highlights a psychological trap. When projections show a large future balance, people relax and save less. When projections look bad, people panic or give up. In both cases, the projection controls behavior instead of guiding it. Collins doesn't say projections are useless. Instead, he reframes their role. Projections should be treated as rough directional tools, not precise forecasts. Their value is in helping you understand relationships, how saving more, spending less, or investing differently affects your financial independence timeline. The key takeaway is this: focus on what you can control. You can control your savings rate. You can control your expenses. You can control whether you stick to a simple, disciplined investment strategy. You cannot control market returns. By shifting attention away from exact numbers and toward consistent habits, Collins sets the tone for the rest of the book. Wealth isn't built by predicting the future correctly. It's built by preparing for uncertainty and staying the course over time. This chapter reinforces a central theme: simplicity, flexibility, and discipline matter far more than perfect predictions. Chapter 3 introduces one of the most memorable concepts in the simple path to wealth: money. J.L. Collins uses this phrase to describe a specific level of financial independence. Not extreme wealth, but enough money to give you real power over your choices. Collins explains that most people underestimate how much money they actually need to change their lives. You don't need a mansion or luxury lifestyle. You need enough invested wealth so that your basic living expenses are covered, without depending on a paycheck. Once you reach that point, your relationship with work changes completely. Money gives you leverage. It allows you to walk away from a job you hate, refuse unreasonable demands, or take risks that would otherwise feel impossible. You can leave a toxic environment, negotiate better terms, or choose work that aligns with your values instead of your fears. The chapter emphasizes that this kind of freedom doesn't come from income alone. High earners without savings are just as trapped as low earners. Real security comes from saving aggressively and investing wisely, so your money starts working harder than you do. Collins also points out that fear is a major driver of bad decisions. People stay in bad jobs, tolerate poor treatment, or avoid change because they're financially fragile. Money removes that fear. It creates psychological freedom long before you reach traditional retirement. Importantly, Collins frames money as a practical goal, not an emotional slogan. It's built slowly through consistent saving, low expenses, and long-term investing. There are no shortcuts. By the end of the chapter, the message is clear. Money is not about impressing others or buying status. It's about independence. Money is the point where you stop being controlled by financial pressure and start making decisions on your own terms. This concept becomes a core motivation for everything that follows in the book. In Chapter 4, J.L. Collins tackles one of the most common fears investors have: what to do when the market is either soaring or crashing. Most people believe they need to change their strategy depending on market conditions. Collins argues the opposite. Reacting emotionally to bull and bear markets is one of the fastest ways to destroy long-term returns. He explains that bull markets create overconfidence. When prices rise quickly, people feel smart, take more risks, and assume the good times will last forever. This is when investors chase hot stocks, increase leverage, or abandon discipline. historically. These decisions lead to poor outcomes once the market inevitably turns. Bear markets, on the other hand, create fear. Falling prices trigger panic selling. People move to cash, stop investing, or swear off the market entirely, often locking in losses at the worst possible time. Collins emphasizes that bear markets are not failures of the system. They are a normal and necessary part of how markets work. The key lesson of the chapter is simple. The market will do what it does. Regardless of your emotions, you cannot control market cycles, but you can control your behavior. Collins advocates sticking to a consistent investment plan through both extremes. He also reframes downturns as opportunities. When prices fall, future returns improve. For long-term investors who are still accumulating, bear markets allow you to buy productive assets at a discount, as long as you keep investing. Collins stresses that the goal is not to predict market movements or avoid volatility. The goal is to own a broad slice of the market, keep costs low, and stay invested for decades. This chapter reinforces a central theme of the book. Success in investing has far less to do with intelligence or timing, and far more to do with patience, discipline, and emotional control. Whether markets are euphoric or terrifying, the strategy stays the same, and that consistency is what builds real wealth over time. In Chapter 5, J.L. Collins confronts one of the most emotionally charged topics in investing, the certainty of market crashes. He opens with a blunt message: a major market crash is always coming. No one knows when, how severe it will be, or what will trigger it, but history guarantees it will happen. Collins explains that this reality makes many investors search for protection. They turn to economists, market experts, forecasts, and predictions, hoping someone can tell them when to get out and when to get back in. The problem is simple. Even the smartest experts consistently fail at predicting crashes. If they could do it reliably, they would already be impossibly rich. The chapter highlights that financial media thrives on fear and certainty. Bold predictions attract attention, but they don't improve results. Investors who act on these predictions usually end up selling too early, buying back too late, or missing the strongest recovery periods, which often happen quickly and unexpectedly. Collins emphasizes that crashes are not exceptions to the system. They are part of it. Every long-term market chart includes sharp declines followed by recoveries. The wealth created by markets exists because they are volatile, not in spite of it. Instead of trying to avoid crashes, Collins argues investors should build a strategy that can survive them. This means accepting volatility, owning broad market index funds, keeping costs low, and maintaining an asset allocation that allows you to stay invested during downturns. He also stresses the importance of psychological preparation. The biggest risk during a crash isn't the market, it's your reaction. Panic selling turns temporary declines into permanent losses. The core takeaway is straightforward. You cannot eliminate risk, forecast crashes, or outsource responsibility to experts. What you can do is design a simple, resilient plan and stick with it. This chapter reinforces a central lesson of the book. Long-term success comes from accepting uncertainty, not trying to outsmart it. In Chapter 6, J.L. Collins explains a hard truth. Most people don't lose money in the market because the market fails. They lose money because of how they behave inside it. Collins starts by pointing out that the stock market, over long periods, has been an extremely effective wealth-building machine. Yet despite this, the average investor consistently underperforms the market. The reason isn't bad luck or lack of intelligence, it's emotional decision-making. The chapter breaks down the most common mistakes investors make. People buy when prices are high because optimism feels safe. They sell when prices are low because fear feels urgent. This cycle, buying high and selling low, quietly destroys returns over time. Collins also criticizes complexity. Many investors believe that more activity equals better results. They trade frequently, chase trends, rotate strategies, and constantly optimize their portfolios. In reality, this behavior increases costs, taxes, and mistakes while reducing long-term gains. Another major issue is overconfidence. Investors believe they can spot winning stocks, time the market, or exit before crashes. Collins is clear, even professionals fail at this consistently. Individual investors, with less information and more emotion, are at an even greater disadvantage. The chapter emphasizes that the market rewards patience, not cleverness. The biggest gains often occur during short, unpredictable periods. Missing just a few of the best days can permanently damage long-term performance, and those days often happen during volatile, uncomfortable times. Collins argues that the solution is not better predictions, more information, or more control. The solution is simplicity and discipline. Own the market through broad index funds. Keep costs low. Stay invested. Ignore noise. The core message of this chapter is straightforward. The market itself is not the enemy. Your reactions to it are. By understanding why most people lose money, Collins sets the stage for doing the opposite. Building wealth by doing less, not more, and letting time do the heavy lifting. In Chapter 7, J.L. Collins shifts from mindset to practical decision-making, focusing on the key considerations and basic tools investors need before putting money to work. The purpose of this chapter is not to overwhelm, but to help readers avoid common structural mistakes early on. Collins starts by emphasizing that where and how you invest matters, even before choosing specific investments. Factors like taxes, fees, account types, and access can have a long-term impact on results. These are not exciting topics, but they quietly determine how much of your returns you actually keep. One major consideration is taxes. Collins explains that taxes are a guaranteed cost. Unlike market returns, using tax-advantaged accounts when available, such as retirement accounts, allows your money to compound more efficiently over time. Ignoring tax structure can undo years of good investing behavior. Another key factor is cost. Expense ratios, transaction fees, and advisor fees may seem small, but compounded over decades they can consume a significant portion of your wealth. Collins reinforces a central theme of the book. Low costs are one of the few advantages individual investors can reliably control. The chapter also discusses tools, not in the sense of complex financial products, but simple mechanisms like brokerage accounts, retirement plans, and index funds. Collins warns against confusing tools with strategies. Tools are just containers. The strategy remains long-term, passive ownership of productive assets. Importantly, Collins cautions readers not to over-optimize early on. Perfection is not required. Getting started with a reasonable setup is far more important than waiting for the best option. Complexity often leads to paralysis. The takeaway from Chapter 7 is practical and grounded. Before chasing returns, make sure the foundation is solid. Understand the basic rules of the game, taxes, costs, and access, and use simple tools that support long-term discipline. This chapter prepares the reader to invest with intention, not guesswork, and sets the stage for the more specific investment discussions that follow. In Chapter 8, J.L. Collins focuses on a financial tool that is often misunderstood and underused, the Health Savings Account, or HSA. Most people think of an HSA as just a way to pay medical bills with pre-tax dollars. Collins argues that this view misses its real power. He explains that an HSA is one of the most tax-advantaged accounts available. Contributions go in pre-tax, the money grows tax-free if invested, and withdrawals for qualified medical expenses are also tax-free. This triple tax advantage makes the HSA unique. Collins encourages readers to think of the HSA not as a short-term spending account, but as a long-term investment vehicle. Instead of using HSA funds immediately for medical expenses, he suggests paying those costs out of pocket when possible, and allowing the HSA balance to compound over time. The chapter highlights an important reality. Healthcare expenses are almost guaranteed later in life. By letting HSA investments grow for decades, you create a dedicated pool of money to cover those future costs, without draining other retirement assets. Collins also notes that after a certain age, HSA funds can be used for non-medical expenses without penalty, though taxes will apply, similar to a traditional retirement account. This flexibility adds to the account's value as part of a broader financial independence strategy. However, Collins is careful to point out that HSA letters are only available to those enrolled in high-deductible health plans. They are not mandatory, and they are not suitable for everyone. The key is understanding how they fit into your overall plan. The main takeaway from Chapter 8 is simple. If you have access to an HSA and can afford to invest the money long-term, it can be a powerful tool for building wealth and protecting against future healthcare costs. Used correctly, an HSA is far more than a medical spending account. It's a strategic asset in the path to financial independence. In Chapter 9, J.L. Collins uses real-life case studies to show how the principles discussed so far actually play out over time. Instead of theory, this chapter focuses on behavior, decisions, and outcomes, and why simple strategies consistently outperform complex ones. Collins walks through examples of individuals with different income levels, career paths, and starting points. The key lesson is that success is not driven by timing the market, picking stocks, or earning an unusually high salary. It's driven by saving consistently, investing simply, and staying the course. One case study highlights someone who starts investing early and remains disciplined, even through market downturns. Despite facing crashes and volatility, this investor continues buying, avoids panic selling, and benefits from compounding over decades. The result is financial independence without stress or constant decision-making. Another example shows how emotional reactions can derail progress. An investor who jumps in and out of the market, follows predictions, or changes strategies during downturns ends up with far lower returns. Despite having access to the same market opportunities, the difference is behavior, not intelligence. Collins also emphasizes how time in the market outweighs almost everything else. Starting earlier, even with smaller amounts, creates a massive advantage. Waiting for the perfect moment or higher income often costs more than people realize. The chapter reinforces that these outcomes are repeatable. They are not lucky exceptions. Anyone who follows the same basic rules, spend less than you earn, invest the difference in low-cost index funds, and ignore noise, dramatically increases their odds of success. The takeaway from Chapter 9 is straightforward. The simple path works in the real world, not just in theory. The market rewards patience and consistency, and punishes emotional decision-making. By grounding the strategy in real examples, Collins makes the case that wealth building is not mysterious, it's behavioral. And that's good news, because behavior is something you can control. In Chapter 10, J.L. Collins explains why he is deeply skeptical of investment advisors, especially for people pursuing long-term wealth and financial independence. His criticism is not personal, it's structural. Collins starts by pointing out a fundamental conflict of interest. Most investment advisors are paid through fees based on assets under management, commissions, or products they sell. This means their income depends on complexity, activity, and control, not on how simple or effective your strategy is. He argues that the best investing approach for most people is extremely simple: low-cost index funds, long-term holding, and minimal interference. The problem is that simplicity doesn't generate ongoing advisory fees. As a result, advisors often introduce unnecessary complexity, multiple funds, frequent adjustments, and complicated strategies that add cost without adding value. The chapter also challenges the idea that advisors can reliably outperform the market or protect investors from downturns. Collins is clear: if professionals could consistently predict markets, crashes, or winning investments, they would not be selling advice. History shows that most advisors fail to beat basic index funds over time, especially after fees. Another issue Collins raises is psychological dependence. When investors rely on advisors to make decisions, they often fail to understand their own money. This lack of understanding increases panic during market declines and makes people more vulnerable to poor advice. Collins is careful to acknowledge exceptions. Fee-only fiduciary advisors who focus on education, planning, and simplicity can be helpful, especially for complex situations. But for most people, especially early in their investing journey, an advisor is unnecessary. The core message of Chapter 10 is direct. No one will care more about your money than you do. Learning the basics, keeping costs low, And sticking to a simple plan will outperform most professional advice over the long term. This chapter reinforces a key theme of the book: doing less, not more, is often the smartest financial decision. In Chapter 11, J.L. Collins uses the idea of magic beans as a metaphor for investments that promise extraordinary returns with little effort. These are the strategies, products, or opportunities that claim to beat the market, eliminate risk, or deliver fast wealth. Collins' message is simple: if it sounds like magic, it probably isn't real. He explains that throughout financial history, there have always been magic beans. From hot stock tips and complex funds to new asset classes and exclusive strategies, they are marketed using confident language, impressive charts, and selective success stories. What they all share is the promise of something better than boring, long-term investing. Collins points out that people are naturally drawn to these ideas because they appeal to emotion. They offer hope, excitement, and the illusion of control. But the cost of chasing magic beans is usually high. These strategies often come with higher fees, higher risk, and greater complexity, all of which reduce long-term returns. The chapter reinforces a key principle: markets already price in available information. If an investment truly offered superior returns with less risk, it wouldn't be available to the average investor. By the time something is widely promoted, the advantage is already gone. Collins also emphasizes that magic beans distract investors from what actually works: time. Compounding, low costs, and discipline are not exciting, but they are reliable. Chasing the next big thing often leads to frequent changes in strategy, poor timing, and emotional decisions. Importantly, Collins is not saying innovation is bad or that new investments are always scams. He is saying that most people don't need them. The simplest strategy, owning the total market through low-cost index funds, already captures global economic growth. The takeaway from Chapter 11 is direct: there are no shortcuts to building wealth. Every time you are tempted by something that promises easy gains, remember the magic beans. Real wealth is built slowly, predictably, and without hype, and that's exactly why it works. In Chapter 12, J.L. Collins defends index fund investing by addressing its critics and explaining why the concept has been attacked for decades, even though it consistently works. At the center of this chapter is Jack Bogle, the founder of Vanguard and the pioneer of the index fund. Collins explains that index funds are often criticized because they don't try to beat the market. Critics argue that owning everything guarantees average results. Collins responds with a simple point: average market returns are actually exceptional when costs are kept low and time is allowed to work. The chapter highlights why index funds face so much opposition from the financial industry. Index funds are simple, transparent, and cheap. They require no stock picking, no market timing, and no ongoing management. This threatens an industry built on complexity, activity, and high fees. When investors choose index funds, there is far less money to be made selling advice or products. Collins also explains that actively managed funds must overcome a major hurdle: costs. Even if managers are skilled, fees and expenses create a structural disadvantage. Over long periods, these costs compound against the investor, making it extremely difficult for active funds to outperform broad market indexes consistently. Jack Bogle's philosophy was straightforward: capture the market return, minimize costs, and let compounding do the work. Collins reinforces that this approach is not based on opinion, but on decades of data. The chapter also addresses the emotional discomfort of index investing. It feels passive and boring. There's no story, no hero, and no sense of control. But Collins argues that boredom is a feature, not a flaw. It reduces mistakes and emotional interference. The core takeaway from Chapter 12 is clear: index funds work precisely because they remove ego, prediction, and unnecessary complexity. By aligning yourself with the market instead of fighting it, you dramatically increase your odds of long-term success, which is exactly why this approach continues to endure, despite the criticism. In Chapter 13, J.L. Collins directly challenges the belief that stock picking is a skill most people can master. His position is blunt: he can't consistently pick winning stocks, and neither can you. This isn't a lack of intelligence or effort. It's a structural reality of how markets work. Collins explains that modern stock prices already reflect massive amounts of information. Professional investors, analysts, algorithms, and institutions continuously analyze every public company. By the time an individual investor hears about a great stock, that information is already priced in. Any perceived advantage is usually an illusion. The chapter also highlights survivorship bias. We hear stories about people who picked Apple, Amazon, or Tesla early, but we rarely hear about the thousands of stocks that failed or underperformed. Looking backward makes success appear obvious, but investing decisions are made without knowing the future. Collins points out that even professional fund managers struggle to pick winners consistently. Study after study shows that most active managers fail to beat the market over long periods, especially after fees. If full-time experts with vast resources can't do it reliably, the odds are even worse for individual investors. Another issue is emotional interference. Stock picking encourages frequent decision-making: when to buy, when to sell, when to double down. Each decision introduces emotion, bias, and the risk of poor timing over time. These mistakes compound. Collins contrasts this with index investing. Instead of trying to guess which companies will win, you own them all. Winners naturally grow to represent a larger portion of the index, while losers shrink or disappear. No predictions required. The key takeaway from Chapter 13 is simple and practical. You don't need to be right about individual stocks to build wealth. By accepting that you can't predict winners, you free yourself from unnecessary risk and stress. Owning the entire market removes ego, reduces mistakes, and dramatically improves long-term outcomes, which is exactly why Collins recommends it. In Chapter 14, J.L. Collins challenges a widely accepted investing principle: dollar cost averaging, or DCA. While DCA is often presented as the safest and smartest way to invest, Collins explains why he believes it is suboptimal for long-term wealth building. Collins starts by clarifying what DCA really is. It's the practice of gradually investing money over time instead of investing it all at once. The logic is emotional protection, reducing the risk of investing right before a market drop. While this may feel safer, Collins argues that it comes with a measurable cost. The core issue is that markets tend to go up over time because of this upward bias. Money invested earlier has more time to compound. By delaying investment through DCA, you are intentionally keeping money out of the market, which historically reduces long-term returns. Collins points out that DCA is often recommended not because it performs better, but because it helps investors feel more comfortable. It's a psychological strategy, not a performance strategy. For people who would otherwise panic or refuse to invest at all, DCA may be useful. But from a purely mathematical standpoint, lump sum investing wins most of the time. The chapter also emphasizes that waiting for a better entry point is just another form of market timing. Whether you spread money out over months or hold cash on the sidelines, you are making a bet that prices will fall, a bet that usually fails over long periods. Collins is careful to note exceptions. For investors who receive income gradually, such as through a paycheck, investing as money becomes available is not DCA, it's simply investing. The criticism applies mainly to situations where a lump sum is already available. The takeaway from Chapter 14 is clear. Time in the market matters more than timing the market. Investing sooner, not later, gives compounding the greatest advantage. DCA may reduce anxiety, but long-term wealth is built by staying invested, not waiting. In Chapter 15, J.L. Collins explains how the financial media creates so-called market experts and why their advice is usually useless for long-term investors. The chapter is not about teaching you to become a guru, but about exposing how the system rewards predictions, not results. Collins points out that financial television and news outlets need constant content. Markets move every day, so commentators are expected to explain those movements and predict what comes next. The problem is that no one actually knows. Markets are driven by countless variables, many of them unpredictable. To fill this gap, media experts confidently offer explanations and forecasts. They speak in definitive language, use complex charts, and sound authoritative. This creates the illusion of insight, even when their predictions are no better than random guesses. Collins emphasizes that these experts are not held accountable. When predictions fail, which they often do, there are no consequences. The next day, a new prediction replaces the old one. Viewers remember the rare correct calls and forget the many wrong ones, reinforcing false credibility. The chapter also explains why this kind of commentary is dangerous for investors. Constant predictions encourage action, buying, selling, adjusting portfolios, even when no action is needed. This leads to higher costs, poor timing, and emotional decisions. Collins contrasts this with successful long-term investing, which requires very little activity. The best strategy doesn't provide daily talking points, doesn't react to headlines, and doesn't make for exciting television. The key takeaway from Chapter 15 is straightforward. The louder and more confident the prediction, the less useful it is. Financial media is entertainment, not guidance. By understanding how gurus are created, investors can tune out noise, ignore forecasts, and stay focused on what actually works, owning the market, keeping costs low, and letting time do the heavy lifting. This chapter reinforces a core principle of the book. Doing nothing is often the smartest investing move. Chapter 16, titled More, is a continuation chapter where J.L. Collins expands on earlier ideas and addresses common, follow-up questions that readers typically have at this point in the book. Rather than introducing a new strategy, this chapter reinforces why simplicity and restraint remain the core of successful investing. Collins revisits the tendency investors have to constantly look for additions, more funds, more strategies, more adjustments. He explains that once people understand the basic approach of saving aggressively and investing in low-cost index funds, the next instinct is often to ask, "What else should I add?" His answer is usually nothing. The chapter emphasizes that doing more does not mean doing better. Each additional investment, strategy, or tweak increases complexity and raises the risk of mistakes. More funds mean more rebalancing, more emotional decisions, and more opportunities to interfere with compounding. Collins also touches on the idea of second-guessing. Investors who constantly review performance and compare themselves to others often feel compelled to make changes, even when their plan is working as designed. This behavior undermines long-term results. Another key point is that boredom is a signal of success. If your investment strategy feels dull and uneventful, it's probably doing its job. Excitement usually means speculation, not investing. The chapter reinforces the importance of trusting the process. Markets will fluctuate, headlines will change, and new products will appear, but the underlying strategy remains sound. Adding complexity rarely improves outcomes and often worsens them. The takeaway from Chapter 16 is simple and reinforcing. Once you have a solid plan built on low costs, broad diversification, and long-term discipline, the best move is to stop tinkering. Wealth is built not by constant improvement, but by consistency. And sometimes, the smartest choice is to resist the urge for more. In Chapter 17, J.L. Collins explains the role of bonds in a long-term investment strategy and why they exist, alongside stocks, even though stocks provide higher returns over time. This chapter is about understanding risk management, not maximizing gains. Collins starts by clarifying the fundamental difference between stocks and bonds. Stocks represent ownership in businesses and offer growth, but they are volatile. Bonds are loans, typically to governments or corporations, and they provide stability and predictability. The trade-off is lower returns. The key purpose of bonds, according to Collins, is emotional and structural stability. Bonds reduce volatility in a portfolio. When stock markets crash, high-quality bonds often hold their value or even rise. This stability makes it easier for investors to stay invested and avoid panic selling during downturns. Collins emphasizes that bonds are not meant to outperform stocks. They are meant to protect you from yourself. A portfolio that is too aggressive may look good on paper, but if it causes you to panic and sell during a crash, the strategy fails in real life. The chapter also discusses how age and financial position affect bond allocation. Younger investors with steady income and long-time horizons may need few or no bonds. As investors approach financial independence or begin drawing from their portfolios, bonds become more important as a buffer against market volatility. Collins is careful to keep the bond discussion simple. He favors high-quality, low-cost bond funds, particularly U.S. government bonds, and warns against reaching for yield through risky bond products. Higher yields usually mean higher risk, and bonds are not the place to take that risk. The takeaway from Chapter 17 is straightforward. Bonds are not about excitement or performance. They are about stability, protection, and staying the course. Used correctly, bonds allow investors to endure market crashes without abandoning their plan, which is essential for long-term success. In Chapter 18, J.L. Collins moves from theory into portfolio construction, explaining how to combine stocks and bonds into a structure that can both build wealth and protect it over time. The focus is not on finding the perfect portfolio, but on understanding the trade-offs behind simple, effective choices. Collins starts by reinforcing a key idea. There is no single best portfolio for everyone. The right portfolio depends on factors like risk tolerance, time horizon, and whether you are still accumulating wealth or beginning to live off it. What matters most is choosing a portfolio you can stick with through market crashes. He presents several example portfolios, ranging from 100% stocks to more balanced stock and bond mixes. A stock-heavy portfolio offers higher long-term growth but comes with greater volatility. A portfolio with bonds sacrifices some growth in exchange for stability and smoother performance. Collins emphasizes that volatility is not just a mathematical concept, it's a psychological one. A portfolio that looks good on paper but causes panic during downturns is a bad portfolio in practice. The best portfolio is the one that allows you to stay invested when markets fall sharply. The chapter also reinforces simplicity. Collins prefers portfolios built from a small number of broad, low-cost index funds, rather than complex allocations with many moving parts. Complexity does not reduce risk, it usually increases it. Another key point is flexibility. Your portfolio does not have to remain static forever. As your life circumstances change, approaching financial independence, retiring, or drawing income, your allocation can shift toward more stability. The main takeaway from Chapter 18 is that portfolio design is about balance, behavior, and durability, not optimization. You are not trying to win a competition. You are trying to fund your life reliably. By keeping portfolios simple, low-cost, and aligned with your ability to tolerate risk, you greatly improve your chances of long-term success and avoid the mistakes that derail most investors. In Chapter 19, J.L. Collins focuses on one of the most important decisions an investor will ever make: asset allocation. How much of your portfolio is invested in stocks versus bonds? Collins makes it clear that this decision matters far more than picking funds, timing the market, or finding clever strategies. He starts by defining asset allocation as a balance between growth and stability. Stocks drive long-term wealth creation, but they come with volatility. Bonds reduce volatility, but at the cost of lower returns. There is no perfect allocation, only one that matches your ability to stay invested during market stress. Collins emphasizes that risk tolerance is not theoretical. Many people believe they can handle volatility until they actually experience a major market crash. Seeing your portfolio drop 30%, 40%, or more is emotionally challenging, and investors often discover their true tolerance only after it's tested. The chapter stresses that the biggest danger is choosing an allocation that is too aggressive. A portfolio that is panic selling during downturns will fail, regardless of its long-term potential. It's better to accept slightly lower returns with an allocation you can stick with than to abandon a plan at the worst possible time. Collins also explains how life stage matters. Investors who are still accumulating wealth and have stable income can afford to take more risk. Those approaching financial independence or drawing from their portfolios need more stability to protect against sequence of returns risk. Importantly, Collins warns against constantly adjusting allocation based on market conditions. Changing your stock-to-bond mix because of fear or excitement is just another form of market timing. Asset allocation should be set intentionally and changed slowly, based on life circumstances, not headlines. The core takeaway from Chapter 19 is simple. Asset allocation is about behavior, not optimization. The right allocation is the one that lets you sleep at night and stay invested through crashes. Once set correctly, asset allocation becomes the backbone of a durable, long-term wealth strategy. In Chapter 20, J.L. Collins addresses a common investing question. Should you invest in international stock funds? His answer is nuanced. He explains why international exposure sounds logical in theory, but may be unnecessary for most investors in practice. Collins starts by acknowledging the argument for international diversification. Different countries grow at different times, and owning global stocks appears to reduce risk. On the surface, this makes sense. However, Collins challenges whether international funds actually deliver meaningful benefits. He explains that large U.S. companies already operate globally. When you invest in a total U.S. stock market index, you are indirectly exposed to international growth through multinational corporations. These companies earn revenue worldwide while operating under U.S. regulations, accounting standards, and shareholder protections. The chapter also highlights risks specific to international investing. These include currency fluctuations, political instability, weaker corporate governance, and higher costs. International funds tend to have higher expense ratios and less transparency compared to U.S. index funds. Collins points out that international markets have not consistently outperformed the U.S. market over long periods. While there are times when international stocks do better, predicting those periods is just another form of market timing, something the book repeatedly warns against. Importantly, Collins does not say international funds are wrong or dangerous. Instead, he frames them as optional, not essential. Investors who want international exposure can include it, but it is not required to achieve diversification or long-term success. The chapter reinforces a central principle of the book: simplicity beats complexity. Adding international funds increases moving parts without guaranteeing better results. For many investors, a U.S. total market index already provides sufficient diversification with lower cost and less risk. The key takeaway from Chapter 20 is clear. You don't need international funds to build wealth, and adding them should be a deliberate choice, not an assumption. Sticking with what you understand, can tolerate, and can hold through volatility remains more important than global optimization. In Chapter 21, J.L. Collins brings everything together and presents what he calls the simplest path to wealth. After discussing behavior, risk, costs, asset allocation, and market realities, he strips the strategy down to its most basic and effective form. Collins argues that for most people, the optimal approach is shockingly simple: save aggressively and invest primarily in a single, broad, low-cost total stock market index fund. No stock picking, no sector bets, no constant adjustments, just ownership of the entire market. He explains why this works. A total market index fund owns thousands of companies across every industry. As the economy grows, the fund grows. Winners naturally rise to the top, losers fade away, and new companies are added, all without the investor needing to take action. This approach eliminates several major risks at once. It removes the risk of picking the wrong stocks. It reduces the temptation to time the market. It minimizes fees and taxes. Most importantly, it reduces the chance of emotional mistakes during volatility. Collins acknowledges that the simplicity feels uncomfortable to many investors. People want to do something. They want control, insight, and optimization. But the desire for activity is often the biggest threat to long-term success. The chapter also reinforces that simplicity improves behavior. When your portfolio is easy to understand, it's easier to stick with it during market crashes. You're less likely to panic, overreact, or abandon your plan at the worst possible time. Collins is clear that this strategy is not about maximizing returns at all costs. It's about maximizing the probability of success. By choosing a path that is simple, low cost, and durable, you greatly increase your odds of reaching financial independence. The takeaway from Chapter 21 is direct. the simplest path works because it aligns with reality. Markets grow over time, costs matter, and human behavior is the biggest variable. When in doubt, do less. In Chapter 22, J.L. Collins addresses a very practical concern. What if you can't invest in VTSAX or even use Vanguard at all? Since much of the book references Vanguard's total stock market index fund, Collins makes it clear that the strategy is not tied to a single company or fund. The core principle, Collins explains, is owning the total market at the lowest possible cost. VTSAX is simply one implementation of that idea, not the idea itself. If VTSAX is unavailable due to employer plans, geographic restrictions, or account limitations, the solution is to find an equivalent. Collins encourages investors to look for total market or broad market index funds. Regardless of the provider, many firms offer funds that track similar indexes, such as total U.S. stock market funds or S&P 500 funds. While these funds are not identical, they are close enough for practical purposes. He also explains that even an S&P 500 index fund can be an acceptable substitute, although it only includes large companies. Those companies represent a significant portion of the U.S. economy. Over long periods, the performance difference between a total market fund and an S&P 500 fund is relatively small. Cost remains a critical factor. Collins stresses comparing expense ratios and avoiding funds with high fees, unnecessary complexity, or active management disguised as indexing. The goal is broad diversification with minimal drag. The chapter reinforces flexibility without abandoning simplicity. Investors do not need perfect funds to succeed. They need reasonable, low-cost options and the discipline to stay invested. The key takeaway from Chapter 22 is reassuring. The simple path works almost anywhere. You are not dependent on one fund, one company, or one platform. As long as you focus on low costs, broad diversification, and long-term ownership, you are following the strategy correctly. The specific fund matters far less than sticking to the philosophy behind it. In Chapter 23, J.L. Collins explains why Vanguard plays such a central role in his investing philosophy, and why it is fundamentally different from most financial institutions. Collins starts by clarifying that Vanguard is not special because it predicts markets better or offers secret products. Its advantage comes from its ownership structure. Vanguard is owned by its funds, which are owned by the investors themselves. There are no outside shareholders demanding profits. This structure creates a powerful incentive. Vanguard exists to serve investors, not to extract revenue from them. As a result, Vanguard relentlessly focuses on lowering costs, improving efficiency, and keeping products simple over time. These small cost differences compound into large advantages for investors. Collins contrasts this with traditional investment companies, where profits come from higher fees, complex products, and constant activity. In those systems, investors' returns are reduced so companies and shareholders can earn more. Vanguard reverses that relationship. The chapter emphasizes that costs matter more than most people realize. Even a fraction of a percent in fees can consume a massive portion of long-term returns. Vanguard's commitment to ultra-low expense ratios directly increases the share of market returns that investors keep. Collins also highlights Vanguard's role in popularizing index funds and investor education. By promoting passive investing and transparency, Vanguard challenged an industry built on stock picking, forecasting, and complexity. Importantly, Collins reminds readers that Vanguard itself is not the goal. The goal is alignment. Vanguard simply happens to be one of the few institutions structurally designed to align its success with its investors' success. The key takeaway from Chapter 23 is straightforward. Vanguard is trusted, not because it promises more, but because it takes less. When an investment company is designed to minimize conflicts of interest and maximize investor returns, simplicity and low costs naturally follow, and that's why Vanguard fits so well into the simple path to wealth. In Chapter 24, J.L. Collins explains how different retirement accounts, or buckets, work, and why understanding their tax treatment is more important. than obsessing over specific investments. Collins groups accounts into three main categories based on how they are taxed: tax-deferred, Roth, and taxable. Each bucket has a role, and using them correctly improves long-term results without changing your investment strategy. Tax-deferred accounts include traditional 401ks, 403bs, TSPs, and traditional IRAs. Contributions reduce taxable income today, and investments grow tax-deferred. The trade-off is that withdrawals in the future are taxed as ordinary income. Collins explains that these accounts are powerful for building wealth, especially during high-earning years. Roth accounts work in the opposite way. Contributions are made with after-tax dollars, but qualified withdrawals are tax-free. Collins highlights the value of Roth accounts for flexibility, tax diversification, and protection against future tax increases. Taxable accounts offer no tax advantages upfront, but they provide maximum flexibility. There are no age restrictions, contribution limits, or required withdrawals. Collins emphasizes that taxable accounts are not bad. They are often necessary once tax-advantaged space is fully used. The chapter stresses that the investment strategy stays the same across all buckets. You don't need different funds or approaches for different accounts. Simplicity and consistency still apply. Collins also warns against focusing only on contribution limits or chasing tax tricks. The goal is to fill the right buckets at the right time based on income level, tax bracket, and life stage. The key takeaway from Chapter 24 is clear. Tax location matters, but it doesn't need to be complicated. By understanding how each bucket is taxed and using them intentionally, you keep more of what you earn. This chapter reinforces a recurring theme of the book. Smart structure quietly boosts results without adding complexity or risk. In Chapter 25, J.L. Collins explains a problem many investors don't discover until it's too late: the downside of tax-deferred accounts when it's time to withdraw the money. While tax-deferred accounts are powerful during accumulation, they come with an ugly surprise on the back end. Collins starts by acknowledging that accounts like traditional 401ks and IRA letters are extremely effective while you're working. You get an immediate tax break, your money compounds tax-deferred, and your portfolio can grow quickly. The problem appears when withdrawals begin. Every dollar withdrawn from a tax-deferred account is taxed as ordinary income, not capital gains. This can push retirees into higher tax brackets than expected, especially if they have large balances, Social Security income, pensions, or required minimum distributions. Collins explains required minimum distributions, or RMDs, which force you to withdraw money whether you need it or not. These withdrawals can increase taxes, reduce flexibility, and even trigger higher Medicare premiums. Investors who aggressively use tax-deferred accounts may end up with less control over their income than they planned. The chapter also highlights the risk of future tax increases. Tax rates are historically low, and there's no guarantee they will stay that way. Deferring taxes only makes sense if future tax rates are lower, an assumption that may not hold. Collins is not arguing against tax-deferred accounts. Instead, he stresses balance and awareness. Overloading a single tax bucket can create problems later, even if it looks optimal today. The key takeaway from Chapter 25 is simple but important. Tax deferral is not tax elimination. Every dollar deferred comes with a future tax bill. By understanding the trade-offs early and planning across different tax buckets, investors can avoid the ugly surprise and keep more control over their money in retirement. In Chapter 26, J.L. Collins delivers a cautionary message. No one is immune to being conned, especially when it comes to money. Intelligence, education, and experience do not protect people from bad financial decisions. In fact, they can sometimes make people more confident and more vulnerable. Collins explains that financial scams and bad products don't usually look like obvious fraud. They are often wrapped in professional language, complex explanations, and promises of safety, sophistication, or exclusive access. Many are sold by people who appear trustworthy, confident, and well-intentioned. The chapter emphasizes that complexity is a major red flag. When an investment requires long explanations, proprietary models, or special insight to understand. It often exists to benefit the seller, not the investor. Complexity creates confusion, and confusion creates dependence. Collins also points out that fear and greed are the primary tools used to con investors. Fear of missing out pushes people into speculative opportunities. Fear of loss pushes them into expensive protection products. In both cases, emotions override logic. Another danger is social proof. When friends, colleagues, or authority figures endorse an investment, skepticism drops. Collins stresses that popularity does not equal safety. Many bad ideas spread precisely because they sound reasonable and are widely accepted. The chapter reinforces a recurring theme. If you don't understand it, don't invest in it. You do not need exotic products, complex strategies, or insider opportunities to build wealth. Simple, transparent investments already work. Collins also reminds readers that responsibility cannot be outsourced. Even when working with professionals, you must understand the basics of where your money is going and how it earns returns. The core takeaway from Chapter 26 is clear. Staying wealthy is as much about avoiding mistakes as it is about making good decisions. By sticking to simplicity, low costs, and investments you fully understand, you dramatically reduce the risk of being conned and protect the wealth you've worked hard to build. In Chapter 27, J.L. Collins addresses a question many people overlook until it actually happens. What do you do once you reach financial independence? Getting there, having enough invested wealth to cover your expenses, is not the finish line. It's the beginning of a new phase with different risks and priorities. Collins explains that the biggest shift is psychological. When you are no longer accumulating, the focus moves from growth to preservation and sustainability. The goal is no longer to maximize returns, but to make sure your money lasts through market crashes, inflation, and long retirements. One key point in this chapter is the importance of simplicity during the withdrawal phase. Complexity increases the risk of mistakes. Collins encourages investors to keep their portfolios easy to manage and easy to understand, especially when income depends on them. He also emphasizes flexibility. Financial independence does not mean you must stop working entirely. Many people choose to work part-time, consult, or pursue passion projects that generate some income. This additional income reduces pressure on the portfolio and increases long-term security. Collins discusses the role of cash and bonds once you get there. Having a buffer, money that is not exposed to stock market volatility, allows you to avoid selling stocks during market downturns. This reduces sequence of returns risk, one of the biggest threats to retirees. Another important theme is lifestyle control. Overspending after reaching financial independence can undo years of discipline. Collins stresses maintaining awareness of expenses and avoiding lifestyle inflation, even when markets perform well. The core takeaway from Chapter 27 is that financial independence is about optionality, not excess. You don't need to squeeze every dollar from your portfolio. You need a plan that lets you live well, sleep at night, and adapt as conditions change. Reaching there is not about stopping. It's about managing wisely so freedom lasts. In Chapter 28, J.L. Collins tackles one of the most practical and anxiety-producing questions after reaching financial independence. How much can you safely spend without running out of money? This chapter focuses on turning a portfolio into a sustainable lifestyle. Collins begins by emphasizing that spending is the reverse side of saving. During the accumulation phase, the goal is to invest as much as possible. Once you are financially independent, the goal becomes withdrawing responsibly while preserving the portfolio. He introduces the idea that spending must be tied to portfolio size, not emotion or optimism. Just because markets have performed well recently does not mean spending can increase indefinitely. Market returns are volatile, and early retirement years are especially sensitive to downturns. Collins discusses the importance of understanding sequence of returns risk, the danger of experiencing major market declines early in retirement. Poor returns combined with high spending can permanently damage a portfolio, even if long-term averages look good. Rather than giving a rigid formula, Collins stresses flexibility. Spending should adjust based on market conditions. In strong markets, spending can be more relaxed. In weak markets, tightening expenses can dramatically increase portfolio survival. Small spending adjustments early can have large long-term benefits. The chapter also reinforces the value of having non-portfolio income, such as part-time work, consulting, or side projects. Even modest income can significantly reduce withdrawal pressure and improve long-term security. Collins emphasizes that financial independence does not mean reckless spending. Discipline does not disappear once you win the game. Awareness and intentionality remain critical. The core takeaway from Chapter 28 is clear. Sustainable spending is about balance, flexibility, and humility toward uncertainty. You don't need to spend every available dollar. You need to spend in a way that allows your wealth to support you through good markets and bad ones. Spending wisely is what turns wealth into lasting freedom. In Chapter 29, J.L. Collins explains how to apply the 4% rule in real life, moving from theory to execution. While the 4% rule is often mentioned as a simple guideline, Collins makes it clear that how you actually pull that 4% matters. He begins by clarifying what the 4% rule is, withdrawing roughly 4% of your portfolio value per year, adjusted for inflation, with a high probability of lasting decades. But Collins emphasizes that this rule is not a guarantee. It is a starting framework, not a rigid system. Collins explains that withdrawals should be planned thoughtfully across different account types. Taxable accounts, tax-deferred accounts, and Roth accounts each have different tax consequences. Pulling money in the wrong order can increase taxes unnecessarily and reduce long-term flexibility. He discusses the importance of managing cash flow rather than selling investments every month. Collins favors maintaining a cash buffer. This allows you to cover expenses without being forced to sell stocks during market downturns, which protects the portfolio from sequence of returns risk. The chapter also stresses adaptability. If markets are strong, withdrawals are easier and portfolios recover quickly. If markets decline sharply early in retirement, reducing withdrawals, even temporarily, can dramatically improve outcomes. The 4% rule works best when paired with spending flexibility. Collins cautions against treating the portfolio like a paycheck. Markets do not deliver smooth returns, and expecting consistent income can lead to poor decisions. Instead, retirees should think in terms of annual planning and portfolio health. Another key point is that emotional discipline remains critical. Fear during downturns can lead to overcutting spending, while confidence during bull markets can lead to overspending. Balance matters. The core takeaway from Chapter 29 is clear. The 4% rule is a tool, not a promise. When used with flexibility, tax awareness, and a buffer against volatility, it becomes a practical way to turn investments into sustainable income. Pulling 4% successfully is less about precision and more about behavior. In Chapter 30, J.L. Collins focuses on Social Security, how secure it really is, and when it makes sense to start taking benefits. This chapter addresses common fears, confusion, and misinformation surrounding one of the most important income sources for retirees. Collins begins by tackling the fear that Social Security will run out of money. He explains that while the system faces long-term funding challenges, Social Security is not going away. Even in worst-case projections, the program would still be able to pay a significant portion of promised benefits. Political pressure makes complete elimination extremely unlikely. The chapter emphasizes that Social Security should be viewed as a stable, inflation-adjusted income stream, not a gamble. Unlike market-based income, Social Security payments are not affected by market crashes, which makes them a valuable stabilizing force in retirement planning. Collins then discusses the decision of when to take benefits. Claiming early results in smaller monthly payments for life, while delaying increases the benefit. Collins explains that delaying Social Security is effectively purchasing a higher guaranteed return, backed by the government, something difficult to replicate elsewhere. He highlights that delaying benefits can be especially powerful for those with sufficient assets to cover early retirement years. A larger guaranteed income later in life reduces portfolio withdrawals and provides protection against longevity risk, the risk of living longer than expected. However, Collins avoids rigid rules. The right time to take Social Security depends on health, family longevity, marital status, and personal risk tolerance. The decision should be made deliberately, not emotionally. The chapter also addresses the role of Social Security within the broader portfolio. It functions like a bond, providing steady, predictable income, and allows investors to take slightly more risk elsewhere if appropriate. The key takeaway from Chapter 30 is clear. Social Security is a critical, reliable component of financial independence, and understanding how and when to use it can significantly improve long-term security. Handled thoughtfully, it becomes one of the strongest foundations of a resilient retirement plan. In Chapter 31, J.L. Collins explores charitable giving and how financial independence changes the way people can give. The chapter's core idea is that smart giving is not about generosity alone. It's about structure, efficiency, and long-term impact. Collins begins by pointing out that most people give emotionally and reactively. They donate when asked, during crises, or at the end of the year, without a plan. While well-intentioned, this approach is often tax inefficient and limits how much impact the money can have. He explains that wealthy individuals often give very differently. They use tools like donor-advised funds DAFs to separate the decision to give from the decision of when and where the money is distributed. This allows them to take immediate tax deductions while spreading donations over time. Collins highlights how appreciated assets, such as stocks or index fund shares, can be donated instead of cash. By doing this, donors avoid capital gains taxes while charities receive the full value. This strategy allows people to give more without reducing their own financial security. The chapter also reinforces that giving does not require extreme wealth. Anyone who has built financial independence can apply these same principles. Thoughtful giving is about planning, not income level. Collins encourages readers to think of giving as part of their overall financial strategy, not as an afterthought. Just like investing, effective giving benefits from simplicity, low friction, and long-term thinking. Another key point is intentionality. Giving should align with personal values, not social pressure. Financial independence allows people to support causes they genuinely care about, on their own terms. The core takeaway from Chapter 31 is clear. You don't need to be a billionaire to give like one. By using smart structures and understanding tax efficiency, ordinary investors can dramatically increase the impact of their generosity. In the end, wealth becomes more meaningful when it's used deliberately, not just to buy freedom, but to create positive change. In Chapter 32, J.L. Collins explains how financial independence changes the way people can give, and why smart generosity is less about emotion and more about structure, efficiency, and intent. Collins starts by pointing out that most charitable giving is unplanned. People donate reactively, when asked, during disasters, or at the end of the year, without considering taxes, timing, or long-term impact. While the intention is good, the execution is often inefficient. He contrasts this with how wealthy individuals approach giving. Instead of donating cash impulsively, they use tools like donor-advised funds DAFs to give strategically. A DAF allows donors to contribute assets, receive an immediate tax deduction, and then distribute the money to charities over time. This separates the tax decision from the giving decision. One of the most powerful ideas in the chapter is donating appreciated assets instead of cash. By giving shares of stock or index funds that have increased in value, donors avoid paying capital gains taxes while charities receive the full market value. This allows people to give more without reducing their own financial security. Collins emphasizes that these strategies are not reserved for billionaires. Anyone who has built financial independence can apply them. Smart giving is not about the size of your wealth. It's about understanding the rules and using them intentionally. He also reinforces that giving should align with personal values, not guilt or social pressure. Financial independence gives people the freedom to support causes they truly care about, on their own timeline. The key takeaway from Chapter 32 is clear. Effective giving is planned, tax-efficient, and values-driven. When done thoughtfully, generosity becomes a sustainable part of your financial life, not a sacrifice. In Collins' view, This is where money reaches its highest purpose, not just buying freedom, but creating meaningful impact beyond yourself. In Chapter 33, The Afterword, J.L. Collins steps back from tactics and strategies and reflects on the broader meaning of the journey outlined in The Simple Path to Wealth. This chapter is less about new information and more about reinforcing the mindset behind everything that came before. Collins reminds readers that the goal was never to create the most optimized portfolio or squeeze out the highest possible return. The goal was to build a system that works in the real world, one that ordinary people can follow, understand, and stick with through decades of uncertainty. He emphasizes that simplicity is a strength, not a limitation. In a financial world filled with noise, predictions, and complexity, choosing a simple path is a deliberate act. It reduces mistakes, lowers stress, and increases the likelihood of long-term success. The afterword also reinforces the importance of personal responsibility. Collins stresses that no one cares more about your money than you do. While tools, funds, and institutions matter, the biggest factor is your behavior, your ability to stay disciplined, ignore hype, and remain patient during market extremes. Collins reflects on the emotional side of financial independence. Wealth is not about winning or proving intelligence. It's about peace of mind, flexibility, and control over your time. The value of the simple path becomes most obvious during market crashes, when complexity and speculation fail. He also reminds readers that this path is not about deprivation or fear. It's about aligning money with life priorities. Saving and investing are tools to support a meaningful life, not ends in themselves. The core takeaway from the afterword is clear. You don't need brilliance, luck, or constant action to build wealth. You need clarity, discipline, and the willingness to stay the course. The book closes by reaffirming its central promise that a simple, low-cost, long-term approach is not just effective, but liberating. In Chapter 34, The First 10 Years, J.L. Collins focuses on what he considers the most critical and challenging phase of the wealth-building journey, the early years. This chapter explains why the first decade matters more than any other, and why it feels the hardest. Collins begins by addressing a common frustration. In the early years, progress feels slow. Savings are small, investment balances don't look impressive, and market fluctuations seem to matter more. Many people lose motivation during this phase because results are not yet visible. He explains that this is normal and unavoidable. Compounding is not linear. In the beginning, growth comes almost entirely from your contributions, not from investment returns. The portfolio hasn't had enough time to generate meaningful momentum. Collins emphasizes that this phase requires discipline and patience. The temptation to chase higher returns, experiment with strategies, or abandon the plan is strongest when balances are small. Unfortunately, this is also when mistakes are most damaging, because habits formed early tend to last. The chapter reinforces that saving rate matters more than returns in the first 10 years. Increasing income, controlling expenses, and consistently investing surplus cash have a far greater impact than trying to outperform the market. Collins also highlights that market downturns early on are not disasters. They are advantages. When you are accumulating, lower prices allow you to buy more shares. The real risk is quitting, not volatility. Another key point is mindset. The first 10 years are about building systems and behavior, not wealth. Once discipline is established and compounding takes over, progress accelerates dramatically. The core takeaway from Chapter 34 is simple but powerful. The first 10 years are about endurance. Stay consistent, keep costs low, ignore noise, and trust the process. If you can get through this phase without sabotaging yourself, the rest of the journey becomes much easier and far more rewarding. The Simple Path to Wealth by J.L. Collins delivers one central message that runs through every chapter. Building wealth is not about intelligence, predictions, or complexity. It's about behavior, simplicity, and time. Throughout the book, Collins systematically dismantles the myths most people believe about money. He explains that retirement is not an age, but a financial condition. The real goal is financial independence. Having enough invested assets to support your life so work becomes optional, not mandatory. A recurring theme is that the financial industry profits from confusion. High fees, complex products, forecasts, and expert advice often exist to benefit sellers, not investors. Collins argues that the more complicated an investment strategy becomes, the more likely it is to fail in the real world. Instead, the book lays out a remarkably simple framework. Spend less than you earn. Save the difference aggressively. Invest consistently in low-cost, broad market index funds. Ignore noise, predictions, and market drama. Stay invested for decades. Collins emphasizes that behavior matters more than math. Most people don't lose money because markets fail. They lose money because they panic, chase trends, overtrade, or abandon their plan during downturns. By choosing simplicity, you reduce the number of decisions you have to make and the number of mistakes you can make. The book also addresses the full life cycle of money. It covers accumulation, portfolio construction, asset allocation, taxes, withdrawal strategies, Social Security, healthcare costs, and charitable giving. At every stage, the recommendation remains the same. Keep costs low, stay flexible, and design your finances to support your life, not dominate it. One of the most powerful ideas in the book is FU money, money that gives you options. Not luxury, not excess, just enough independence to say no to bad situations and yes to better ones. That freedom is the true return on investing. Collins does not promise market-beating returns. He promises something more valuable, a high probability of success. By aligning your strategy with how markets actually work and how humans actually behave, the simple path dramatically improves your odds of building lasting wealth. The final takeaway is clear. You don't need brilliance, timing, or luck. You need discipline, patience, and the willingness to stay boring. And boring, done consistently, is powerful. If you found this breakdown helpful, hit like so more people can discover it. Subscribe for more clear, no hype summaries of the best personal finance and investing books. And comment below, what's the hardest part of staying consistent with investing? Fear, discipline, or patience? Thanks for watching. And remember, the simplest path is often the strongest one.